Mortgage lenders are failing. I'm your host, Steve Van Metre, and thanks for joining me today. And with interest rates rising and financial conditions tightening, it was only inevitable that we would see mortgage lenders start to fail. Except this time, it's going to be worse than the great financial crisis. Let's go to Bloomberg, where we picked today's story up with the headline that U.S. mortgage lenders are starting to go broke. And after the crisis, banks now account for less of the mortgage business as more independent brokerage lenders are taking over. The U.S. mortgage industry has seen its first lenders go out of business after a sudden spike in lending rates, and the wave of failures that's coming could be worse since the housing bubble burst about 15 years ago. There's no systemic meltdown, at least not yet, because there hasn't been the same level of excess lending and because many of the biggest banks pulled back from mortgages after the financial crisis. But market watchers nonetheless expect a string of bankruptcies broad enough to trigger a spike in layoffs in an industry that employs hundreds of thousands of workers and potentially an increase in some lending rates. More of the business is now controlled by independent lenders, and with mortgage volumes plunging this year, many are struggling to stay afloat. And these non-banks are poorly capitalized, and when the mortgage market tanks, they're in trouble. And this is by design. And I want you to understand that this is intentional, because we're going to see as we continue to go through this that you remember what happened in the great financial crisis. Who took the brunt of the blame? The big banks. And the regulators didn't like that, and the banks didn't like it. So what they tried to do is put a buffer between them and the mortgage industry, and think of these independents as frontline soldiers. When things go wrong, they go down, and hey, no big deal to the big banks because they're immune from this. So I want you to understand exactly why these firms aren't capitalized, is they weren't intended to be capitalized. They're literally just volume mortgage producers. In 2004, only about a third of the top 20 lenders for refinancings were independent firms. Last year, 2/3 of the top 20 were non-bank lenders, according to lendingpartners.com. And since 2016, banks have seen their share of the market shrink to about a third from about half, according to Inside Mortgage Finance. And once interest rates start to climb, lending volume shrank across the industry. That meant the company could no longer find enough new loans to bundle or get enough financing to keep operating, said First Guaranty's chief executive officer. And First Guaranty employed 600 people before it filed bankruptcy in June and made $10.6 billion in loans last year, according to court records. Days before seeking court protection, the company fired 471 workers because it couldn't get enough financing to overcome a cash crunch. And here's a perfect example of what's going on and why these companies are on the front line. Because imagine if, big bank like Wells or B of A, they laid off a bunch of people. Well, they would make the news. But First Guaranty, doesn't make the news. And that's by design of what this new system is. It's designed to put a layer between the mortgage originators and the big banks, so that when things go wrong, well, it doesn't impact the major banks. Let's continue forward. Because independent lenders gained a toehold in the market because banks pulled back so much after the 2008 financial crisis was started with excess lending and mortgages. And regulators have often encouraged the retreat, and it's still happening. As Wells Fargo, the biggest Wall Street firm in the U.S. mortgage business, plans to shrink its home loan empire. And again, who are these regulators that you hear about? Well, who is the biggest banking regulator of them all? The Federal Reserve. And, again, you look back to the great financial crisis. Who took the heat? It was the big banks. Who bailed out the big banks? Yeah, the Fed. And who took the heat? A lot of people did not like the fact that the Fed bailed out the banks. So if you're the Fed and you don't want to do this again, and you know that there will be another crisis in the future at some point, and you'll have to run to the rescue, what do? You put a layer in front of the big banks. If that layer goes down, no big deal, because the banks aren't holding all of these mortgages anymore, so that you don't have to worry about bailing them out in the future. You think about it, it's pretty brilliant. And unlike banks, independent lenders often don't have emergency programs that they can tap for financing when times get tough, nor do they have stable deposit funding. They depend on credit lines that tend to be short-term and depend on mortgage prices. So when they're stuck with bad assets, they face margin calls and potentially go under. And part of the reason these companies are distressed is because the loans can't go to the GSEs or government for funding. The options for funding are more limited, which is especially painful when financial conditions are tightening. And so all of a sudden, what are we seeing? Fed raising rates, unwinding their balance sheet, markets are starting to come down, and what are happening if financial conditions are tightening? And that is the story of what's going on here, and that's why you're seeing these firms fail and why we're going to see even more of them, and that is the catalyst, of course, for the next crisis is brewing right here, and you're seeing it in the mortgage space. Now, if you're concerned what that means to your portfolio, well, you shouldn't be. I'll put a link up here to Portfolio Shield in the corner and the description below. Let's continue on, because that's beating down the value of home loans made just a few months ago. And I want you to understand just what these losses are. And as a mortgage made in January is not eligible for government backing, could have traded in early August, somewhere around 85 cents on the dollar. Now keep in mind, these lenders trying to make loans were somewhere around 102 cents to cover their upfront costs. So what you're seeing here is these independents, they're not holding mortgages. They're doing volume amounts of mortgages. They're packaging them up in bonds. And who's selling the bonds? You got it. The big banks. That's how they're making their money. They're not making it on the origination. They're letting these companies make it. They're making it on the sale of those government mortgage-backed bonds. For a lender whose loans drop to 85 cents, the losses can be debilitating even if they aren't realized yet. On top of that, business is broadly plunging. Overall mortgage application volume has plunged by more than 50% this year, something we've talked about on this show. And these business conditions are spurring banks that provide lines of credit known as warehouses to make margin calls or cut credit. Now, what is a warehouse loan? If you're wondering, I've never heard that term, and you probably wouldn't. So in the mortgage origination business, when one of these non-bank lenders is about to do a loan, they need a short-term bridge to do the loan, to originate it, and then between that time and the time they sell it. So what is a warehouse loan? Think of it as just a short-term loan to fund that mortgage, and it lasts just long enough until that non-bank lender sells the loan, pays back the warehouse loan. That's all it is. So when you see them starting to tighten and do margin calls, it's because these warehouse lenders know that bad things are coming. And the warehouse lenders in this industry seem to be extremely on top of things. This downturn, unlike in 2008, said a bankruptcy attorney who was representing creditors in the first guarantee bankruptcy. They're making margin calls quickly. So here what you're seeing is they're calling these loans. Now, why are they doing this? Why is all this happening now? Is it something we could have predicted? Well, it is, because when you understand how banks lend, even non-banks, now how does this work? They borrow at short-term rates, lend at long-term rates. So what happens when long-term rates go below short-term rates, which is called an inversion in the yield curve? Well, guess what? They don't make money. And you see that start to happen, and we could have predicted this because the yield curve is inverted. That's why we talk about this on the show. Last time it was this, even we're close to this inverted, was a great financial crisis, but now we're more inverted than we were going into that. Now only rivaling the dot-com bubble, who had a deeper inversion. At the rate we're headed, we're about to see that happen as well. And where does this translate to? Of course, it means job losses are coming. And we talked about on the show, this is the industry where it starts as mortgage lenders turn desperate as soaring rates, royal industry, and home lending employees are facing risk of job cuts. Slumping business as one of the fastest jumps in mortgage rates starts to cool off the U.S. housing market. And business has started to evaporate across home lending firms in recent weeks after the Federal Reserve boosted borrowing costs to tame decades high inflation. Now, I want you to keep in mind, what is the Fed likely to do in September? Raise rates again. What are we hearing? 50, 75 basis points? That curve inversion is only going to get worse, and so are these layoffs that are coming. U.S. mortgage rates are at levels last seen more than a decade ago, and that's hurting affordability for first-time home buyers and slowing down sales of previously owned homes and making unattractive for existing homeowners to refinance. As we've talked about and shown on this show, the U.S. mortgage refinance, its index, is at super low levels, and we know that when it gets down to these really low levels, that it kind of puts a ceiling on interest rates, particularly on the long rates. And that's how we know that bonds are probably bottoming out here, because when refinances go away, when demand for loans go away, well, rates really don't have anywhere much higher to go. There's only go higher when there's demand. And already the fallout is cascading across the industry as Wells Fargo and Company has warned that income from its mortgage lending business may drop significantly in the second quarter. Employees at the bank's home lending division, its rival JP Morgan unit, are being laid off or reassigned to different areas. Layoffs are happening everywhere. People are cutting rates, cutting costs, with desperate attempts to gain business. And there's a reason why this happens. Again, we come back to the yield curve and you look at the timing of this, and we can go back even here into the 70s. You see the curve inverts, and what happens to the 4-week moving average of initial claims shown in red? It starts to bottom out and go up. And you see the next curve inversion. What do you see? Initial claims start to bottom and go up. Here's another one. In the late 1980s, inversion, bottom in claims. How about going into the dot-com bubble? Inversion, bottom in claims. How about the great financial crisis? Notice inversion, claims are bottoming out. We see just a smidge of an inversion in 2019. Claims are starting to bottom, and now it's happening again. And of course, we talked about in the show, where does it begin? It begins in the mortgage lending industry. It begins in the housing market, and this is where you see layoffs begin. And now you know why. Let's continue on. Because it's an abrupt shift for a sector that was just recently experiencing a hiring boom. The latest job report shows there were 1.8 million Americans working in real estate in May. That's the most on record and almost double the available inventory of existing single-family homes in the U.S. That jobs figure doesn't include all the people working in housing-related roles throughout other industries like finance. And intensified competition among lenders is fueling pressure. Last month, you said she lost almost every loan to a major international bank because their rates were lower than her bank. So now all of a sudden, what are we seeing? These big banks step in and say, hey, we're just going to cut you off at the knees. We're going to take your business away. We're going to let you fail, because they don't care. If these front-end servicing non-bank lenders fail, doesn't matter to them, because guess what? They'll just make up a new name and finance a new non-bank lender down the road, and voila, they're back in business. Again, this is all done deliberately, and I want you to understand that. You only have a small pie. You may have 30, 40, 50,000 agents trying to compete to get this tiny pie, and some banks are suddenly very aggressive. And everybody and their mother was getting into mortgages because it was a hot thing to do, according to a managing director at Guaranteed Rate. I love times like this because it weeds out people that shouldn't be doing what we were doing anyways, because there's a lot of bad lenders out there. It right sizes everything, and that's really the key of what a recession does. It gets out the bad actors, gets out the weak players, the weak hands. You find out real quick who has the money and the resources to survive a recession. They're the ones that survive. And if you're working in that industry, you know it's feast or famine. And when it's feast, you got to set a little money aside for when there's a famine. But more layoffs are coming, and we'll be sure to cover that as they come. And now you know exactly why. It's the yield curve. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.